Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Have you ever wondered why breaking news about interest rates or a single tweet from some self proclaimed tech guru can send a company's stock plummeting or soaring? Let's dive straight into the heart of the stock market and unravel how it really works, why it matters, and maybe uncover a thing or two that'll make you question the sanity of financial headlines. The stock market exists for one simple reason: businesses need money to grow, and investors want a shot at making more money than their savings account would ever dare to offer. When a company needs to raise funds, say to develop a new product, expand into a new country, or just pay off some mind boggling debt, it can offer a piece of itself for sale. That's a share of stock. The moment you own that share, you're part owner of the company. Sure, you don't get a key to the executive washroom, but you do get a potential claim on the profits through dividends, and, in theory, a voice in how the company is run. Businesses benefit because they raise the capital they need without having to beg from shady loan sharks, and investors benefit because they might snag a nice profit if the company does well. The principle behind stocks is ownership. Think of it like sharing a pizza with your friends, but instead of pepperoni and cheese, you're splitting up equity in a company. Each slice represents your share of ownership. The difference is that sometimes these slices pay you back if the company does well, or they can leave you feeling like you should have just ordered a burrito if things go south. The reason a share can be worth a handful of dollars one day and nearly double the next isn't sorcery, it's supply and demand. When more people want in on the action, the price heads to the moon. When everyone wants out, that price can nosedive faster than a bungee jumper with a short rope. Speaking of supply and demand, let's dig a bit deeper. If the market believes a company's future looks bright, maybe it just unveiled a groundbreaking technology or has a CEO who's secretly half cyborg with 24/7 productivity, people will likely flock to buy its shares. This drives the price up. On the flip side, if the company suddenly reveals it's been cooking the books or the CEO admits to questionable midnight tweets, shareholders may panic and start dumping their shares, flooding the market with supply. When you mix all these hopes and fears, facts and rumors, hype and panic, you get a price that can gyrate throughout the day, literally up to the very second the market closes. It's capitalism's adrenaline rush in real time. To actually buy or sell stocks, you head to an exchange, a physical or virtual marketplace where these shares are listed and traded. Well, once upon a time, traders shouted orders on noisy floors. Nowadays, much of it happens electronically. Major exchanges like the New York Stock Exchange, NASDAQ, the London Stock Exchange, or even the Tokyo Stock Exchange handle mind-blowing volumes daily. Each one has its own rules, listing requirements, and sometimes even a bit of pomp and ceremony. Hello, the opening bell. Whether you trade from your smartphone in bed or from an 80th floor corner office, you tap into these exchanges. They're the matchmakers of the finance world, pairing eager buyers and sellers every millisecond of the trading day. Just when you start wrapping your head around the idea of stocks themselves, along come indexes, which function like the stock market's mood ring. An index, such as the S and AMP Wink with tongue sticking out 500 or the NASDAQ Composite, is basically a curated group of stocks that represent a slice of the market. When you hear a news anchor say, the market's up by 2% today, they're typically referring to an index. If that index is soaring, it generally means investors feel good. Maybe they've had their morning coffee and read some optimistic economic data. If the index is tanking, the mood is grim, maybe some politician just announced a new tariff, or a global crisis has everyone running for cover. Indexes are a handy way to measure overall market sentiment without having to sift through thousands of individual stock quotes like some hyper-caffeinated accountant. Now, let's talk IPO, initial public offering, the financial world's equivalent of a debutante ball. When a private company decides to go public, it's like stepping onto the big stage and saying, I'm available to everyone. IPO day can be a massive celebration. Founders might become instant billionaires, thanks to all those private shares they already own, and the company raises truckloads of cash. But it's not all glitz and glamour. Once the stock hits the exchange, early investors might realize that not every fairy tale ends well. Some IPOs skyrocket, while others fizzle, leaving everyone wondering if it was just hype. The primary market is where these new shares are sold, often to big institutional investors or your everyday broker's clients if they're lucky enough to get in. The secondary market is where most of us do our trading, buying and selling shares that already exist. By the time you load up your trading app, you're typically in the secondary market, rummaging through shares that changed hands countless times since their initial debut. If you're itching to join this roller coaster, you'll do so through a broker. It used to be that you'd call up a well-dressed stockbroker who'd swiftly judge your portfolio size before even acknowledging your existence. Today, it's more likely you'll download an app, link your bank account, and start throwing money around with a few taps, practically from your couch in pajamas. You can place market orders, which execute instantly at whatever the going rate is, or limit orders, which give you more control over the price you pay. Or maybe you'll use a stop loss to bail you out if the price plunges. Just be sure you know what you're doing. The convenience of modern platforms is a double-edged sword. It's never been easier to invest, but it's also never been easier to lose your shirt because you YOLO'd into some meme stock. Of course, when money changes hands at breakneck speed, governments and regulators start hovering like hawks. The US has the SEC, while many countries have their own watchdogs. They keep an eye out for shady activities, like insider trading where an executive dumps shares after accidentally reading the board's super secret merger plans, or pump and dump schemes that revolve around artificially hyping a stock, then selling at a peak while clueless investors are left holding the bag. Sure, this oversight can be a little heavy-handed, and yes, sometimes it only catches the small fish while the big fish slip away. But generally speaking, without regulation, the stock market would be even wilder than it already is. Imagine a medieval bazaar with random pickpockets, except everyone's wearing suits and ties. So, what exactly influences stock prices besides supply and demand? Practically everything. Rising inflation can eat away at corporate profits. If the central bank hikes interest rates, investors might panic because borrowing becomes more expensive and corporate growth could slow. Political events, from elections to international trade wars, can trigger major swings in sentiment. Technology changes just as quickly, making some companies obsolete while propelling others to stardom. And let's not forget market psychology. Sometimes stocks move for reasons that have nothing to do with actual value. People can get caught up in waves of fear or euphoria. You might see investors piling in because they don't want to miss out on the next big thing, or frantically selling because they fear an apocalypse is just around the corner. It's a mix of real fundamentals and raw emotion, like a daytime soap opera, except with billions of dollars on the line. Now, let's discuss risk and volatility. Stocks can swing up or down by several percentage points in a day, sometimes more if you're dabbling in smaller companies or so-called growth stocks. That's volatility. It can be thrilling, like riding a roller coaster after eating too much cotton candy. But it can also leave you nauseated if your portfolio swings wildly. Risk is the chance you'll lose money, either because the stock price drops or you panic and sell at the worst possible time. Some folks try to manage risk by diversifying, spreading their money across different industries, regions, and asset types. They might hold some blue chip stocks, maybe a few growth companies, and even some bonds to cushion the blow. In theory, if one area flops, another might hold steady or flourish, evening out your returns so you don't end up screaming into your pillow every night. For beginning investors, the first tip is simple. Don't bet your rent money on a stock tip from your chatty barista, no matter how persuasive they sound. Educate yourself. Seriously, read books, watch more videos, and don't just rely on random social media influencers who swear they have the next stock that'll go to the moon. Also, set goals. Are you investing for a vacation next year, or is this about building a retirement nest egg over 20 years? Your goals and your tolerance for risk will shape how you pick stocks. If short-term thrills are your jam, you might go for trendier, riskier plays. If you're in it for the long haul, maybe consider strong, stable companies that pay consistent dividends. Try not to let a single day's price movement give you a heart attack. It's easier said than done, but remember, the market can be a drama queen, overreacting to rumors and short term noise. Before wrapping up, let's piece everything together. The stock market is a marketplace, a massive exchange of ownership slices in various companies. Its existence is rooted in the need for capital and the quest for returns. You buy a share, you own a piece of a business. The value of that share depends on countless factors: economic indicators, political winds, corporate performance, and even investor emotion. Exchanges make trading possible, and indexes help gauge the market's overall health. When companies debut on the market through IPOs, they transition from private to public, opening the door for all sorts of opportunities and pitfalls. Brokers and trading platforms are your gateway, but they come with potential hazards if you jump in blindly. Regulators monitor the space, but can't always prevent every shady deal or meltdown. Economic data, global events, and psychological twists all mix together to drive prices on this never ending roller coaster. And while there's money to be made, there's also money to be lost. Risk and volatility are your companions on this ride. Finally, a good grounding in the basics, some level headed decision making, and a touch of skepticism toward market hype can go a long way in making the stock market less terrifying and more rewarding. Use the tools out there: watch lists, charts, company reports, and yes, solid financial analysis. Stay curious, stay patient, and remember that for every dramatic market crash you see on the news, there have been plenty of recoveries, often even stronger than before. If that still sounds too risky, you might prefer the gentle lull of a savings account, although it's not exactly an adrenaline filled route to grow your wealth. Ultimately, the stock market is what you make of it, an opportunity or a gamble, depending on how you approach it. And if you ever find yourself screaming at your portfolio after a sudden plunge, just remember, the only thing certain about the stock market is that nothing is certain. Embrace the chaos, and you might just find it a fascinating place to explore.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.